Hey, it's Mike. Before we get started on this episode, I just wanted to give you a heads up that the first two time Amy talks, there's some echo in her audio. It clears about midway through that second time she's talking, and it's good after that. So just wanted to give you that heads up. If it's really annoying, you can just fast forward to about 2 minutes in, and the audio is good after that. Thanks for listening.
Today, we're going to be talking about another one of those great debates in financial planning, and that's whether you should save in a traditional or a Roth retirement account.
My answer is everyone's favorite answer from a financial planner or tax advisor. It depends. But this week, our goal is to help you understand the difference and when one might be more appropriate for your situation.
Yeah, that's right. Always the standard answer for financial planning. But yeah, today we'll walk through how the accounts work, differences between the accounts, withdrawal requirements, and when you should consider using each of these.
Welcome to Operation Retirement Readiness, where Amy and Mike, two certified financial planners, talk about how military members can prepare for transition and how veterans can prepare for ultimate retirement. This podcast represents the views of the hosts and any guest. It is for informational purposes only and should not be considered tax, financial, or legal advice. All information is regarded to be from reliable sources. The hosts are not responsible for any losses, damages, or liabilities that may arise from the use of this podcast. This podcast is not intended to replace professional advice.
Amy, in the intro, we mentioned that while it's often debated and people like to, talk about this like they talk about the survivor benefit plan we did a few weeks ago, people are passionate about Roth versus traditional. And, it's not always easy to figure out. So why is that?
One of the problems is that there's imperfect information at a given time. Lots of assumptions.
Oh, so is that's all you need to consider?
I'm sure I missed some other things, but yeah, that's pretty much the long and the short of it.
All right, so let's start with the basics. Most retirement accounts come in two different options, one being the traditional, the other being a Roth. For example, you could have a traditional IRA or a Roth IRA. You could have a traditional 401k or a Roth 401k. And the TSP, 403bs, and many of the other retirement accounts that are less common also have these features. So the primary difference really ends up being how those accounts are taxed and when they're taxed.
Yeah, so let's start with the original. So the traditional versions of all of those types of accounts that you mentioned, they're the original, they're the oldest. The traditional account allows you to take a tax deduction now. So when you make your contribution, you don't recognize that income in the year in which you make that contribution. There's some limitations around this, particularly with respect to the IRAs. But once the money's in the account, so you haven't paid tax on it, it grows tax deferred. But then you'll pay taxes when you make your withdrawals in retirement later on. Now, there's no income limitations to contribute to a traditional IRA. So I mentioned that there might be limitations with the traditional IRA. Anybody can contribute to a traditional IRA, but there could be income limitations for whether or not you get to actually take tax deduction on your tax return. The maximum IRA contribution for 2024 is $7,000 for those under 50 and $8,000 for those who are 50 or older.
Yeah, and the Roth account basically flips this. You use after-tax dollars, meaning you don't get a tax deduction when you make your contribution, but your earnings continue to grow tax-free, and anytime you take a withdrawal, subject to some specific rules, it's tax-free. So there are income limitations for Roth accounts, and like the traditional, if we're talking on the IRA side, you can contribute $7,000 if you're under 50, or $8,000 if you're over 50, and based on your modified adjusted gross income, which you can find on your tax form. If you're single and your income is under $146,000, you qualify to put in the full $7,000 or $8,000. That gradually phases out up to $161,000, and if you're making more than that as a single person, you don't qualify. For married, filing jointly, the income limit for full contribution is $230,000. And that gradually phases out at $240,000. So the withdrawal age for retirement accounts is generally 59 and a half, although there are a few exceptions. Any other withdrawal rules we should be understanding before we make the decision, Amy?
Yeah, there's plenty. So one of the big differences in the traditional retirement accounts that I talked about is that, the idea is you haven't paid taxes on the money that you put into that account, and then it grows tax-free. Well, what the government does in order to make sure that you pay taxes on that money before you die is they have this thing called required minimum distributions, or RMDs. Originally, the rule was that starting in the year in which you turn 70 and a half, actually by April 1st of the year after you turn 70 and a half, you would have to take your first distribution. So a minimum amount that's calculated in the tax code for how much you had to take out. Why 70 and a half? Who only knows? But that was the rule. In the last couple years, we've had two versions of Secure Act, and the RMD ages have started to change. So at this point, if you haven't started your RMDs, then you won't need to start your RMDs until age 73 if you're born in 1960 or later, or age 73. And then those who were born 1960 or later won't need to take them an RMD until age 75. So to clarify, if you're in the military and you're just getting ready to retire, you probably were born after 1960, which means you won't have to take an RMD until age 75.
And Roth IRAs have never had RMDs, and now thanks to Secure 2.0, Congress recently passed, neither do the retirement accounts that you'd have through your workplace if you had a Roth. That used to be one of the kind of, loopholes. It was a strange rule that you had to start taking RMDs out of workplace retirement plans, even if they were Roth. So a lot of times that would cause people to have to roll over their 401ks into IRAs to avoid that. So Congress kind of closed that and said, no, if it's a Roth account, we're not going to make you take an RMD, which is a good thing, and may allow you to stay in a workplace Roth retirement plan if you like it, versus having to roll that to an IRA in the future.
So we talked about when you have to take money out of a traditional IRA. So, as you get older, the government wants to collect their taxes on that money, so they make you take it out. On the flip side, on the front end, when can you take it out? So after age 59 and a half is when you can take out money from your traditional IRA without a penalty. Before age 59 and a half, you will have to pay a 10% penalty plus the taxes if you withdraw the money from your IRA. Now, there's a few exceptions. One of them is a first-time home purchase, up to $10,000 for qualified expenses associated with that purchase. Medical expenses, if the medical expenses exceed 7.5% of your adjusted gross income. Education expenses for higher education, death or disability in certain situations, and then military reservists called to active duty for at least 179 days may be able to make a withdrawal without paying the penalty. Now, those withdrawals are still subject to tax, but you don't have to pay the 10% penalty if you meet one of those exceptions.
One of the unique things about the Roth IRA is that you can always take withdrawal of any contributions you've made at any age. And that's a, relatively unique feature of retirement accounts. Probably don't want to do that. You don't want to impede the compounding machine that's working, but if something came up, you could do that and get to that money. To withdraw earnings, you can do that without a penalty and taxes if you're 59 and a half and the account has been open for at least 5 years. So if you're under 59 and a half and the account is open less than 5 years, you'll pay a penalty and taxes on that money, the earnings, even though if you left it there for longer, you never would pay taxes on that. So the exemptions are the same as Amy just ran through for the traditional IRA, but just know the difference that with a Roth IRA, you can withdraw contributions without penalty. So if something comes up, it can make it a good savings vehicle, even if you're not 100% sure you can leave it forever in that account. Maybe you're going to purchase a home in 10 years and you are interested in using that money. You could use your contributions to make that purchase. Now the workplace plans, they are different and can vary by the individual plan that your employer puts in place. But a couple of points that are specifically governed in the tax code are if you take an early withdrawal from a workplace retirement plan for education or to buy a home, those are not covered. So you will pay the 10% penalty on those. But one of the other unique features is if you end your job after the age of 55, maybe you're retiring early, you can withdraw from your 401k without penalty. You have to end that job to be able to do that, but that is one of the features of the workplace retirement plans.
So, I think because there's so much complexity here, we just went through, rules for the traditional IRA, rules for the Roth IRA, rules for workplace retirement plans. They're all just a little bit different. So the takeaway from this is if for whatever reason you're considering taking money from any sort of retirement account or retirement plan, you really need to do your homework. You need to understand whether or not you're going to pay a penalty now, how much you're going to pay in taxes, if anything. But then you also need to pay attention to what kind of impact this is going to have on your long-term retirement plan. So you need to understand both the short-term consequences as well as the long-term consequences to your financial plan.
Yeah, that's a great point. So we discussed the account basics. So let's talk a little bit about when you'd consider using them. And the first thing to kind of understand, all else being equal, if we had a flat retirement or flat tax rate across the board, say 20%, and everybody paid that on their income, there'd really be no debate over this because you're either paying the taxes up front and then it grows tax-free, or you're putting it in tax, and getting a tax break up front, but then you're going to pay them over on the long term on the growth. So the debate really comes in because we've got this progressive tax system and your percentage of your taxes goes up as your income increases. So the general idea behind the decision is kind of tax rate arbitrage and trying to pay taxes when they're lower and defer taxes when they're higher.
Exactly. So the idea is to choose to pay your taxes on that money when your tax rate is low, and defer the taxes when your tax rate is higher, so that you can pay it when you think that your tax rate will be a little bit lower. So that's the arbitrage. it gets challenging because there's a laundry list of reasons on why you may not know exactly what your tax rates are going to be, even just next year or within the next 5 years. Which means you also may not understand what your tax rate is going to be out in your 70s or 80s. We talked about the RMDs. So if your RMDs are big, you can actually get pushed into a higher tax bracket without realizing that that's what's going to happen. You can't simply assume that when you retire and now you have your pension and Social Security, you're simply going to be in a lower tax bracket. That might be true, but it may not be true if you have to take RMDs. So I know that we're going to dive into a couple scenarios in our next podcast, really dive deep and talk through all of this. But for this episode, Mike, can you please just frame up a couple of times and a couple of examples of when and how you'd used each of these different accounts?
Sure. Let's talk about somebody that's maybe mid-career or 5-10 years from military retirement, and spouse isn't working, so it's just one income coming in. They may be in the 15% tax bracket because, again, you're getting the tax breaks of basic allowance for housing and basic allowance for subsistence. Those things, don't get counted. So your income looks pretty low, even though it probably technically isn't that low. So if you're in that camp, a Roth can make sense, because the odds are, especially if you're going to go through military retirement, like you just said, when you start looking out at Social Security and a pension, you've already got that minimum amount of income coming in that's going to put you into the lower tax bracket. So then you add on, like you said, the RMDs, that may be a good idea to stay in the Roth while you're in the military. And then if you look at specifically the second career scenario, you've made it to military retirement, you're getting your pension, maybe your spouse is going back to work, and you're starting your second career, you could jump, at least one and maybe even two tax brackets, and could be much higher than what you project to be in the retirement. So at that case, then it makes sense to kind of shift to the traditional, where you're deferring taxes, hopefully getting a tax break and doing that. And, and then in retirement, again, hopefully your income tax bracket will drop a little bit and your rate will drop, and then you're making those withdrawals. So it's complex, a lot of things like Amy talked about, and as folks like to say, the tax code's written in pencil. So the idea that we know what the tax rates are going to be in 50, 60 years is a hard problem. But you plan based on what you know, and if you need to, maybe even hedge a little bit, maybe put some in Roth and some in traditional. But just kind of understanding, again, when you're in a lower tax bracket, that's when you want to think about the Roth, and when you're in a higher tax bracket, that's when you want to think about traditional and deferring taxes.
Yeah, and I think we've talked about this just a couple times, but to expand on it further, because this is at least half the equation. At least half the equation is trying to figure out what you think your tax rates are going to be when the money is withdrawn. So you alluded to the fact that Congress can make changes. So obviously that's completely out of your control. We have no idea what Congress will choose to do with taxes. Maybe rates will go up. We're at historically low tax rates right now. These are the lowest tax rates we've seen, I think, in all of history since we've had an income tax. If not the lowest, certainly among the lowest. But it also includes, we mentioned, so you've got your income. It's pretty intuitive. Most people are prepared to take into account their pension, their Social Security, maybe even thinking about the interest and dividends coming off your taxable investments. But something else to keep in mind is that once you're older, if your spouse passes away, then you're you're filing taxes as a single person. So those big withdrawals, if both of you were saving in your IRA and you sort of expected your tax rate to be married filing jointly, but your spouse passes away, you may be surprised to find yourself in a much higher tax bracket because you're having to file at the single rate, but you have the same amount of RMD that's having to come out because of the way the tax calculations work. And then something else that people need to keep in mind, when Secure Act came along, one of the stipulations is that when you leave your IRA to your beneficiary, whether it's a child or a different family member or a friend, whomever you leave it to besides your spouse and a couple other qualified beneficiaries, those people have to take that money out within 10 years. So if that's traditional money, because the 10-year rule actually applies to both Roth amount money and traditional money. But if it's traditional money and you've left it to say, at your children, there's a very good chance they're in their peak earning years right when you've left them a pot of money that will have to come out in a short period of time. So just imagine or assume about 10% per year. So it can have a huge impact on your ability to pass on generational wealth. So it's a lot. There's a lot going on and a lot to consider, and that's half the equation. That's probably the hardest half to figure out.
Yeah, all this to say it's super complex. Like you said, some planners that I've heard on podcasts talk about, you need to decide how you're going to do your tax planning. You can either do it 2, 1, or 0, and that means, two people are still alive and you're projecting that for a long life. You can do it projecting it for, one member of the couple still being alive, or you can do 0, which is looking at the next generation and how taxes would impact them based on what you're inheriting. And like you said, with the traditional having to take that out now within 10 years and pay taxes on it. So, again, it's complex. And then if you add in, conversion strategies, we talked about deferring during your post-military career when your taxes are high. If you retire early before those RMDs or Social Security kicks in, you may drop down into a pretty low tax bracket. And that's where maybe you convert from traditional to Roth IRAs and pay the taxes again because they're lower. But really the only way to know did you make it the best or, an optimal decision is well after you died and really whoever's inherited the account has used it all. You could go back and say, well, did we do okay? I mean, you can make some educated guesses, and that's really what you have to do with any of this is kind of just based on the information we have, the tax rates we know about. You talked about it being historically low. Well, if Congress doesn't act in 2 years, the current rates are going to roll off, and we're going to go back to the pre-Tax Cuts and Job Act numbers. So things will change again. So and if somebody's got a crystal ball and can tell me what if Congress is actually going to do anything this time, or if it's going to just roll off because of inaction, I'd be interested to know what is going to happen. But again, we don't, so we just plan on basically what we know today. So, Amy, did we cover the basics of the Roth versus traditional? I know we're gonna do at least one more, maybe 2 more shows to talk about this more in depth. But anything else you want to hit on?
No, I think we hit the big points. The key takeaways being that the traditional IRA is in traditional accounts, your 401k, your 403b. You're deferring taxes now, so you're not paying tax on that money now. It's going to grow tax deferred, and then you'll pay taxes when the money is withdrawn, and you have to take it out when you're in your 70s. The Roth IRA, you pay taxes on the money that you're investing now, but the growth and the withdrawals are tax-free later on. And I think we really hit home the fact that the decision on which account to use which type of account to use is kind of complex. But the general rule of thumb is use a Roth when you know or are pretty sure your tax rate is lower than your expected tax rate in retirement. And then use on the flip side, so a traditional account when your tax rate is higher than you expect it to be in retirement. So I think that's, those are the three key takeaways, even if the last one isn't crystal clear to everyone right now, because we don't have crystal balls.
Thanks. And as we said, in the next one, we're going to dive even deeper and run through some scenarios on this decision. And so until next time, Amy.
Sounds good. Look forward to talking to you then.
To get transcripts, show notes, or more information, go to operationretirementreadiness.com. Have a question or topic for the podcast? Send it to info@operationretirementreadiness.com. Find out more about Amy and Mike at their websites. Amy is the founder of Instar Financial Planning, LLC. She is retired from the U.S. Army and has worked in the financial services sector since 2019. She's a certified financial planner, a chartered federal employee benefits counselor, and a chartered retirement planning counselor. You can find out more about Amy at instarfp.com. Mike is the founder of Next Mission Financial Planning, LLC. He retired from the U.S. Air Force and has worked in the financial services sector since 2021. He is a certified financial planner, chartered financial consultant, and a certified college financial consultant. You can find out more about Mike at nextmissionfinancialplanning.com.